Morning friends, hope you're all doing great. Today we shall continue from where we left in our previous session. We were discussing employment income. Remember, regarding your previous session, I told you that there are 3 types of benefits that there can be. We did a whole list of exempt benefits. Thereon, there were some benefits which are accessible for all the employees, and then there were a few benefits which are only accessible for P11D employees. For P11D employee, you need to clear the 8,500 earnings test or be a company director, even though if it's a part-time director, as long as you have more than 5% of the company's shareholding, you would be considered a P11D employee. Now let's have a look at all these few benefits that as an employee you can enjoy. What is going to be the taxable, the assessable amount of these benefits? Let's first begin with the living accommodation benefit, which basically means that your employer is giving you a living accommodation, is giving you a house to stay in. Now this living accommodation is definitely a benefit that you're enjoying. Why? Because you do not have to pay rent by living at any outside place, right? So obviously some part of the benefit would be taxable. Now let's have a look at how living accommodation benefit is going to be calculated. This living accommodation, to start off with, has got 3 components. So let's go through the 3 components quickly. The 3 components, first being the annual charge, followed by the additional charge, and thereafter ancillary benefits which there are, and that is the 3 components of the living accommodation. Having added all these 3 charges, you reduce the employee's contribution towards this accommodation that he himself has already contributed. The remaining becomes your assessable amount on the living accommodation. Now these 3 components which you have just mentioned, annual charge, the additional charge, and the ancillary benefits, what are these? Let's do each of these components one by one in detail. So let's have a look at what is annual charge and what it is basically going to comprise of. Annual charge, to begin with, basically means that is an annual charge which is going to be charged to the property, which basically means what is the gross rateable value or the rent paid for the said property during the entire year. So what do we take? What value do we take? We take the higher of, right, so we take the higher of the gross rateable value, which is the annual rented value set by government at the historic rates, or if the rent paid by the employer, which obviously would happen when the employer himself does not own the accommodation. Only then obviously will he be paying rent towards the property. So what you're going to take? You're going to take higher of the 2 charges, the gross annual rate, which basically the gross rateable value, which is basically the annual rented value, which is set by the government at the historic rates, or if the rent paid by the employer is more than that, then definitely you're going to take the higher of the 2 values as the annual charge, which is the first charge to your living accommodation expense. Thereafter, you're also going to charge another charge which is known as an additional charge. Now, additional charge, again, to be able to levy this charge, there are 2 conditions that needs to be met in order for you to levy this additional charge. The first being that the accommodation must be owned by the employer. So the accommodation should be owned by the employer. The employer must have bought this accommodation. He is not paying rent for it. And also what? That the cost of this said property should be more than £75,000. So see, these are the 2 conditions that must be met for in order to the employee to become accessible to pay an additional charge towards the property. Now, what is this additional charge going to be? Let's have a look at that. Additional charge, basically to begin with, is depends upon how old has the property been owned by the employer. Has the employer owned the property for more than 6 years, or is it less than 6 years since the employer has bought this property? So what you're going to look at, you're going to look at how old is the employer, how many years back did the employer buy this property. So you're basically going to start off by looking at the additional charge, which basically is going to be if the property has been owned for less than 6 years, which basically means that it has not been very long since the employer owned this property, then the additional charge you're going to levy to the property is going to be cost minus £75,000 multiplied by the official rate of interest as at the 6th of April. Now, this official rate of interest as at the 6th of April 2016 is 3%. This rate would be provided to you in the question always. So, even if it is not given, you should remember that it is 3%. But it will always be provided to you. Now, what are you basically doing? If the property has been owned by the employer less than 6 years ago, before being first made available, now remember this is extremely important, before being first made available is what you have to look at. Very often the employer will try to confuse you by giving you a lot of prices at different dates. What you have to do, you have to make sure that you are taking at what? You're looking at the number of years it has gone by before the property was first made available. So make sure you do not get confused. You have to look at how many years have passed by since the property was first made available. Is it greater than more years, or is it less than 6 years? If it is less than 6 years, what do you take? You take the historic cost of the property, which basically becomes the rate at which you bought the property minus the threshold level of 75,000. You multiply the difference of the two by the official rate of interest as at the 6th of April, which stands at 3% as at the 6th of April 2016. Now, what is going to be the additional charge if the property, when made first available, was more than 6 years ago? So if this was more than 6 years ago, what is the additional charge that we are going to levy? What do you reckon? I mean, use your common sense. Do you think if the property was first made available more than 6 years ago, so it's been quite a considerable time frame, right? How relevant do you think is this historic cost going to be? Obviously, it is not going to be relevant cost. It is going to be obsolete cost. It is going to be not up to the date cost, right? So instead of using the historic cost, you replace this cost by the open market value of the property when first made available minus 75,000 multiply again by the official rate of interest as at the 6th of April, which is again 3% as at the 6th of April 2016. So what are we doing? Basically, we're starting off depending on the additional charge, considering that both the conditions have been met. What were the two conditions? Let's quickly run through the conditions again. That the employer owns the accommodation and the cost of the accommodation is greater than £75,000. Bear with me, the handwriting is really come poor, so let me just write it again for you. Right, so the conditions being that the property is owned by the employer and the cost is greater than £75,000. So having considered, if you meet both these conditions, you will be liable to an additional charge on the living accommodation benefit which the employer is providing to. So basically, what do you levy? Depending upon how many years have passed since this property was first made available, you're going to look at, is it more than 6 years or has it been less than 6 years? So depending upon how many years have passed by, you're going to consider what is going to be the additional charge. If it is less than 6 years, you're going to do what? You're going to use the historic cost of the property at which you bought the property minus from it the threshold level of 75,000, multiply this with the multiply this with the official rate of interest, which is 3% as at the 6th of April 2016. If it has been more than 6 years since this property was first made available, what are you going to use? You're going to replace this historic cost with the more relevant, with the more recent open market value, which again will be provided to you in the question. You just have to make sure that which figure needs to be picked up is that you are making sure of. The examiner is going to give you all of these figures together: the cost at which you bought it, the open market value, one or two more figures they might want to put in more, the up-to-date value you might want to put it. So basically, do not get confused. Know the correct figure which you need to pick up from the question and just put it in the formula and calculate the additional charge accordingly. Now thereafter, what else is there? What happens if there is cost of improvement done on the property? What about cost of improvements? What are we doing regarding the cost of improvements? The simple rule is that when was this cost of improvement levied? If it was levied before the beginning of the current year, this cost of improvement you're going to capitalize and add it to the cost of the building itself. If, however, this cost of improvement has been incurred during the current year, you're just going to ignore it for the current year. Why? Because what happens come next year? Next year, this cost is going to be incurred before the beginning of the next year. So definitely again the same rule is going to apply and you're going to add it to the cost of the building itself. So let me quickly run it by you again. What do you do with the cost of improvements on the building depending upon when this cost of improvement has been made? If it was done before the beginning of the current year, you're going to add to the cost or the open market value depending upon how many years have passed by. If it has been incurred during the year, that is after the start, what do? This tax year, just completely ignore the cost of improvements incurred during the current year, which basically means after the start of the current year. What else? Now remember, there were 3 charges which I told you, which is going to form part of your living accommodation. We first begin with the annual charge, which was what? Which was higher of the gross rateable value or the rent paid by the employer. The second was the additional charge, which would be levied if both the conditions were met. Both conditions being what? That the cost, that the employer is the one who owns this accommodation and the cost of this accommodation is more than £75,000. Now the third charge being the ancillary charge. The ancillary benefits charge would be levied not on all types of employees but would be levied on only P11D employees. Now remember, P11D employees are the employees that fulfill the 8,500 earnings test, or they are directors, even though they are part-time directors, at least having 5% of the ordinary share capital in the organization. So that's when you become a P11D employee. What is the repercussion of being a P11D employee? There are a set of benefits that become taxable or assessable, as we call it. So basically the benefits like this living accommodation ancillary benefits would only be taxed for P11D employees. So now ancillary benefits like the utility expenses, heating, water, lighting, council tax, all of these are utility expenses. They would be assessable only if you are a P11D employee. What is the charge that you're going to levy to them? The charge is going to be the amount of cost it has actually costed the employer himself. So it is going to be cost to the employer himself is the amount that you're going to charge as the benefit charge, as an ancillary benefit charge onto the living accommodation price, onto the living accommodation that you're going to charge from the employee. So basically, let's quickly run through it again. Like I said, let me just open the journal quickly for you. Right. So living accommodation charge. There are three types of charges on living accommodation. The first being the annual charge, which is basically the higher of the gross rateable value or the rent paid by the employer. So this is what you would be looking at when considering your annual charge. Also, thereafter you would be charged an additional charge. This additional charge would be paid if two conditions are met. What are the two conditions? That the accommodation must be owned by the employer and the cost of this said accommodation needs to be greater than £75,000 to start off with. So that is the additional charge which you are going to add to the benefit of the living accommodation. Now apart from this, there is also another benefit known as an ancillary benefit charge, which would only be accessible on utilities provided you are a P11D employee. What makes you a P11D employee? What makes you an E11D employee is having qualified the 8,500 earnings test. That is what makes you a P11D employee. So make sure living accommodation benefit, you know what to charge, what is the performer. You first begin with the annual charge, add on to the additional charge, and thereafter ancillary benefits depending upon what category of employee you are. So basically that is how you're going to calculate the living accommodation charge to begin with. Now let's do practically a few questions and let's get a better understanding of how we are going to resolve this living accommodation questions. So let me open up a question for you quickly. Right. So let's quickly read through the question. Right. So let's understand this with the help of an example. A company purchased a house in 2011 for £150,000. So the cost is more than £75,000. Capital improvements were made to the house in 2012, costing £10,000, and again in May 2015, costing £20,000. So this is basically, let me quickly grab my pen. Right. This is before. So what do? You add to cost. Now this is May 2015, which is during the current year. So this year what you're supposed to do, you're supposed to ignore this cost, because come 17-18, this cost of improvement would get added to the cost of the building itself. Now let's continue with our question. Right. Let me just write it here. Before this gets added to cost, this gets ignored, right? Neil, the company's managing director. Now, managing director is always a P11D employee. So, you need not calculate the 8,500 earnings test. By default, he becomes a P11D employee. So, the ancillary benefits of this living accommodation would become accessible to this P11D employee. Moved into the house in January 2013. When the market value of the house was £205,000, its value on the 6th of April 2015 had fallen to £185,000. Like I told you, the examiner will always gives you a lot of figures just to confuse you. Now we have to look at open market value or the cost when made first available. So the cost is how much? 150 plus 10, so £160,000. Open market value we have to look at when first made available, so which is 250 £185,000. So either of these two figures we will have to use depending upon how many years have gone by since this property was first made available. Now in this case, it was moved into the house in January 2013. So definitely it has been less than 6 years. So what price are we going to use? We're going to use the cost value and not the open market value instead. This figure of £185,000 has been purely given to confuse you. So make sure that you always ignore this figure regardless of which situation we are falling into, less than 6 years or more than 6 years. This figure of 185,000 is never applicable to us. It's purely given just to confuse us. So let's not get confused. We know it is either going to be the cost or it is going to be open market value. When first made available, it is going to be either of these two values that we have to use depending upon it has been less than 6 years or it has been more than 6 years. This case it has been less than 6 years because it's January 2013. So we are going to make use of cost 160,000 and this open market value again becomes irrelevant to us for this applicable question. So what do? We are going to make sure that we use the cost of £160,000 and at the same time we are ignoring the value which has been given purely to confuse us. Now let's again continue with the question. The gross rateable or annual value of the house is £1,000 and Neil is required to pay £100 a month towards the provision of the house. So this is the gross rateable value, which becomes your annual, which basically becomes your annual value. This is the contribution of the employee which you are going to reduce at the end in order to find out the value of the assessable benefit of the living accommodation. So make sure that as soon as you're reading the question, you're scribbling on the question paper itself which figure goes where, which figure you're going to use when, and which figure is purely for you to ignore it because it is given just to confuse you in the exam. So make sure that you're making your notes as you are reading the question itself. So what do we have here? Right. So we have our gross rateable values. We've been given contribution as well. What else is given to us? During 15-16, the following expenses in connection with the property were paid directly by the company. So we are going to find out which of these ancillary benefits are going to be taxable for this P11D employee because Neil is a managing director of the company. Had this not been told to us, we should have been given enough information to find out the 8,500 earnings test being applicable to Neil or not. Because this has outrightly been given to us, we know that he is already a P11D employee who is liable to pay the ancillary benefits on the living accommodation benefit as well. So let's have a look at the different ancillary benefits: electricity, cleaning and maintenance, structural repairs and council tax. Now we will go through them as when we read the question, when we come back to this point as such. Now let's start with solving our question. Let me just make the question neat for you so that you can copy it down if you wish to. Right, so what do we have? Let's start with the solution. The first benefit being what? The first benefit being we need to find out the benefit of the living accommodation. So we are finding out the living accommodation benefit. We start off with the annual value, which is higher of gross rateable value or rent paid by employer. Now this property is owned by the employer, so obviously he is not paying any rent. So gross rateable value is given, which is equals to £1,000 or 0. So definitely £1,000 is greater than 0, which becomes the annual value of the said property. Now let's move forward. What next do we have? We have an additional benefit to be levied. Why? Because both the conditions both conditions met, which are what? That the property owned by employer plus cost is greater than 75,000 pounds. Now make sure that you are actually writing it in your answer sheet. Do not just charge it and move forward. Give the conditions that this particular property has qualified for it to be liable to pay the additional charge as well. So it's only going to take a microsecond, but make sure that you're actually giving the examiner, you're telling the examiner that yes, I know the rules, that why additional charge has also become accessible for nil. So what do? You write down both the conditions and you actually tell the examiner that both the conditions have been qualified by nil. What next do you do? You're going to this property when first made available has been less than 6 years. So what is the value of additional charge? Additional charge is equals to what? It is equal to, you're going to take value of what? Let me just write it here for you. The additional charge is you're going to take cost. Cost is now equal to, let's go back to the question. Okay, so the cost is going to be equal to 150, the original cost, plus 10,000, which is 160,000 is the cost. Why? Because this is during the current year. This is after the start of the current year. So definitely it isn't going to be ignored this year around. So what do you take? 150 plus 10, which is the cost of the building, is what you're going to take in order to calculate the additional charge on the building, which comes out to be how much? Which comes out to be equals to 150 plus 10 minus 75,000 is your threshold, multiply by what is the rate given to us. It is given to be official rate of interest as at the 6th of April 2016 is what is 3%. So this is what it comes out to be. 2550 is your additional benefit charge. Now there is going to be what? There is going to be an ancillary benefit charge. Just write down in bracket because it's a P11D employee. So you are liable to pay additional ancillary benefit charges. Now what are the different charges which have been told to you? Electricity, very much an ancillary benefit. You have to pay for it. Electricity benefit of how much is given? Electricity benefit of 540 is given to us in the question. What next? There is another benefit of cleaning and maintenance, which is equals to 1572, again becomes an accessible benefit. What about structural repairs? Do you think if as an employee I'm living in a property and the landlord is actually incurring certain expenses to improve the structural repair, the structural infrastructure of the building itself, is it going to be of any benefit to me? Do I have to bear the charges for it? Why? No, because why? It's a long-term benefit which definitely the employer, which is the company in this case, is what needs to bear this structural repair charge. So structural repairs would not be added as an ancillary benefit. What about council tax? Yes, very much a relevant tax. You need to bear the council tax, which is equals to 1,200 pounds. So now that we know these, let's have a look at what is the total living accommodation benefit, which basically becomes equals to the gross value plus the additional benefit plus the ancillary benefits which are being liable to pay plus. Right, so 6862 is the total benefit that there is. Now out of this total benefit of 6862 which the employee is enjoying, he has already contributed how much? £100 a month has been contributed by Neil himself. So definitely his contribution we can reduce it because he's not going to pay tax upon it twice. So what you can do? You can reduce employees contribution, which is equals to £100 a month. So what is the remaining benefit? Remaining assessable benefit comes out to be 6862 minus 1,200. £5,662 is the amount of benefit that Neil will be assessable upon. Now almost the same question. Let's quickly just twist a little bit in the question. What there is, facts as an example. Fine, except that the house was now acquired in 2004 was the house acquired in, which basically means it's been greater than 6 years since the house was first acquired. So what becomes your additional benefit charge? Your additional benefit now becomes, now the cost basically gets replaced by open market value when first made available minus £75,000 of threshold limit. Multiply this by the official rate of interest at the 6th of April. So this is what you need to replace this figure of cost. Now let's quickly solve this. We know what we have. We already have the remaining figures on us. Everything else remains the same except for the amount of additional benefit that there is going to be. So basically it becomes how much? Let's have a look at what is the annual value to begin with. Annual value remains the same, which is £1,000. Additional benefit is now basically both conditions again met. Both conditions met. Becomes what? It becomes open market value when first made available, which is when, which is the January 2013 is when the open market value was £205,000 is what now we are going to use basically. So 205 minus the threshold limit, multiply this by 3%, which is the official rate of interest as at the 6th of April 2016, which now comes out to be £3,900. Also, what next do you add? You add the ancillary benefits, which would again remain the same as we've already done. Electricity. How much was electricity? 540. Then there was cleaning and maintenance. Cleaning and maintenance comes out to be 1572. And then there was council tax to be paid, which is equals to £1,200. Total of this becomes the total value of total living accommodation benefit as it comes out to be equals to that is the total value of the accommodation. What you're going to do again, you reduce employees contribution, which is equals to what? Which is equals to £100 per month The remain becomes the assessable benefit, which is equals to 8,212 minus 1,200. 7,012 pounds is the amount of benefit that you will be liable to pay income tax upon. So that is, we're going to add it as an employment income under your benefits. Now what next? Let's move forward. Now let's have a look at the same accommodation, provided that the accommodation now is a job related accommodation. What is a job related accommodation? It basically means that the accommodation had to be provided to you in order for you to be able to perform your job related duties. So you basically needed the accommodation not as a luxury but as a necessity. Now because this accommodation is a job related accommodation, let's have a look at the specific rules for it. What happens basically if it is a job related accommodation, which is basically what accommodation provided by the reason of employment, that is houses for nurse and doctors. Definitely they need to be provided this or these houses closer to their workplace so that they are able to efficiently perform their job. So definitely what qualifies as the qualifying factors of an accommodation being a job related accommodation is what? That this accommodation needs to be necessary for proper performance of duties. This accommodation provided is customary, provided for better performance of the duties, and it is provided to you for security reasons that you need this accommodation. So basically it is wholly, exclusively and necessarily provided to you for you to be able to perform your job in the correct manner. So this is what is a job related living accommodation. So now that we know what makes accommodation a job related living accommodation, let's have a look at the simple rules for it. What basically happened, because obviously it is not a luxury, it is basically a necessity that you need for you to be able to perform your duties of the job. Definitely it is going to get taxed at a favorable rate. So basically favorably treated for tax. Why? Because the annual and the additional charges both actually become exempt for you. So there is nothing, no amount of annual charge, no amount of additional charge you become liable to pay as an employee if the accommodation has been provided to you, which is customary, which is necessary, which had to be provided to you as part of your job performance duties. So very much a necessity for you to be able to perform your job. So if an accommodation is a job related accommodation, it is treated favorably under tax, which basically means you're not liable to pay any tax as an annual charge, neither do you need to pay any of the additional charges. Both become exempt from tax itself. What happens to basically the other ancillary benefits? Now a few of the ancillary benefits like council tax becomes exempt if it is paid by the employer. The remaining ancillary expenses gets taxed at the lower of what is the total amount of the ancillary benefits, obviously excluding the council tax, because that is now exempt. It is equals to 0, or 10% of the employees net emoluments, which basically means pay and benefits both clapped together. 10% of it is charged, if it is the lower of the two values, is charged as a ancillary benefit charge. Excluding the accommodation, obviously what you reduce the allowable expenses in order to find out what is the taxable value of this benefit, which is a job related living accommodation which has been provided to you by the employer for you to be able to perform the duties of your job. Why? What are the criteria basically? The criteria, let me quickly run it by you again. Let's go on the sheet. Right. So any accommodation becomes a job related accommodation if it is necessary to be provided for you to be able to perform your job. It is customary, as in it is always provided. Like you know, churches are nurses are always given. The nuns of the church are always given an accommodation to live in. The nurses of the hospitals are always given an accommodation to live in. So these are very customary to the profession itself. So they are customary to the profession itself, as well as they are provided for security reasons. So basically all these three make an accommodation a job related accommodation, because it is necessarily provided to you for you to be able to perform your job. It is treated favorably under tax, which basically means, remember the three components of your living accommodation. Let me quickly run it again. Your living accommodation had three components, right? The first being the annual charge, the annual value, followed by the additional charge, and thereafter there was an ancillary benefit charge. So if this accommodation becomes a job related living accommodation, this becomes zero. This becomes zero. Council tax paid by employer becomes zero, and the remaining ancillary benefits are taxed at the lower of the two values, which is basically what? Lower of the two values, which is basically they are going to pay lower of the remaining ancillary benefits, which basically mean excluding the council tax, or 10% of the net emoluments paid by the employer, enjoyed by the employee, is what you're going to take. Now let's have a look at this live with the help of an example, so that you better understand how these figures change when the accommodation becomes a job related living accommodation. So let's open up a question for you quickly. Right, so facts as an example 5 again, except that the house qualifies as job related accommodation. So now what do we have? Instead of the normal accommodation, this house is now a job related accommodation. So which basically means what? The annual charges, the annual value becomes exempt. What also happens? The additional charge becomes exempt. Out of the ancillary benefits, council tax again exempt. The remaining are charged at lower of the remaining, or 10% of the net emoluments. Now what is 10% of net emoluments? It basically means whatever is the pay plus the benefits, out of which you are allowed to reduce the allowable expenses. Now this definitely does not include the value of the accommodation that we are going to calculate. So excluding accommodation, because you are obviously calculating the benefit of it thereof. So now that we know what we need to follow, let's quickly follow the rules and be able to solve this question. So now that this property, this house has become a job related accommodation, what happens? Let's start. Where do we first start off? We definitely start with the annual value, which is now exempt, so which is equals to 0. Also a 0 is your additional charge, which is again now 0. out of your ancillary benefits, what happens? Out of your ancillary benefits, you're going to take why this S is coming. Right, it is going to be lower of what? Lower of the remaining benefits, which is how much? What are the remaining benefits? The remaining benefits as per your question becomes electricity plus cleaning and maintenance. Remember, council tax becomes 0. Cleaning and maintenance. Why? Because council tax again is assumed to be 0. So can we just include these two figures? Electricity is 540. Your cleaning and maintenance 1572. 1572. So this or 10% of net emoluments. Let's do this with the help of a working 1. Let me just calculate it here for you. Working 1, which is equals to, let's calculate the benefit value, the net emoluments. We first obviously begin with the salary. Salary is how much? A salary given to us is 25,000 in the question. Let's get back to the question. Where were we? Salary given is 20,000 pounds is the salary, 25,000 pounds, right, is the salary value which has been given. So what do? We take salary 25,000. We also what do I do? 25,000. I also need to add the value. What do I always do? For my salary, I always reduce my pension contribution, which is equals to what? Let's get back to the question. Now pension contribution is given to us in the question as how much? Pension. Let me open up the question. Right, pension is 4950. Right, 4950 is the amount of pension. Let's get back to the question. This we've already done. Right. So what do we have? How much is left? What do? You add the other benefits. Other benefits, assumingly say, are 170. What becomes the total net emoluments? Net emoluments become equals to salary less pension plus benefits. Let's do 10% of these net emoluments, which now come out to be equals to 10%. $2022 becomes the total value net emolument. So what we have to do, we have to take lower of 2112 or 2022. So obviously we're going to take 2022 as the value of the net ancillary benefits, which is going to become taxable. taxable, assessable benefit value, which equals to how much now? Equals to 0 plus 0 plus 2022 equals to 2022 becomes the total value of accommodation if this house is now basically a job related accommodation that we have been told. Now let's move forward. Right, so let's quickly run through the question again. What we've been told, the accommodation is now a job related accommodation. It's job related accommodation, thus your annual value becomes 0, additional charge becomes 0. What happens to your additional benefits? The ancillary benefits, 4 benefits were told to us. Electricity equals to £540. Then we had cleaning and maintenance equals to 1572. Structural repairs would not be paid by the employer, would not be borne by the employer. So you can ignore them. And council tax, because this is now a job related accommodation, actually becomes 0 instead of the £1,200 it was originally, right? So what do? We know these two benefits. This is the value. We are going to take the lower of either these two value or 10% of the net emoluments, which is given to us in the question has an annual salary of how much? Annual salary of 25,000 is there. Other taxable benefits amounting to 170 is there. Pension contribution is 4950. Where you first reduce your pension contribution, add your other benefits, find out the total net emoluments, find out 10% of these net emoluments. Lower of the two is going to become taxed as your annual value, as your ancillary benefits value becomes the total assessable value for NEEL in this case, right? So nice and easy. All you need to know is know the rules, what these the applicable figure turn out to be in case this accommodation now becomes a job related living accommodation. Having done living accommodation, both job related as well as normal, now let's move on to another benefit which an employee can be provided by the employer, which is known as the vehicle and fuel for private purposes. So which basically means that you have a company car and you are using it for your private purpose, the benefit of which is definitely going to be determined by the amount of CO2 emission that the car actually makes. So you are going to first look at the benefit is going to be based. Let me open up the pen. The benefit is going to be based on the CO2 emission percentage of the manufacturer's list price. So both would be given to you in the question. The CO2 commission percentage as well as the manufacturer's list price would be told to you in the question itself. What you need to look at, you need to check which is the applicable slab rate at which you are following, depending upon the CO2 emission of the car. So the CO2 emission percentage chart would be given to you in the rates and allowances sheet. Let me quickly open it up again for you. Let me just make that for you, depending upon which type of car it is and what level of CO2 emissions it is making level. Let me just make a quick chart for you so that you know how we are going to look at it. Level of CO2 emissions is what you're going to check in the car, and that is going to be the percentage that you're going to levy. Now this depends upon the type of car. Supposingly you're now looking at a petrol car. So for petrol cars, what is that you start off with? If it utilizes 50 grams or less, it is considered at a 5% percentage. If this car is between 51 to 75 grams, the charge is going to be 9%. If this car is between 76 to 94 grams, This percentage changes to 13%. What next? If it is 95 grams or more, this basically changes to the highest rate of 14%. What happens thereafter? For every additional 5% grams up to 210 grams, what do? You basically levi, you add 1% for each 5 grams over 95 grams until what? Until the maximum of 37% is reached, which is basically, this obviously happens at when? At 210 grams is when this is going to happen. Now these are the rules for your car, which is a petrol car. What happens if your car is a diesel car? For diesel cars, what happens basically? Same as for petrol cars, plus diesel supplement of 3% subject to the same 37% maximum limit. Now this chart would be provided to you in your rates and allowances sheet. You need not learn this chart, but you need to know how to practically use these percentages. What percentage are you going to fall under depending upon the CO2 emissions of your car? So what basically you're going to look, you're going to first check whether it's a petrol car or it's a diesel car. So for petrol cars, depending upon what category you're falling at, and for anything more than 95 grams, you're adding 1% for each 5 gram more than 95%, which basically means supposedly it's 100 gram. So what do? 14 plus 1% gets added to you. Till that time, this actually goes on to reaching the maximum level being 37% is where your maximum level is going to get exhausted. Now let's quickly do this with the help of an example. Let's do an illustration to understand this little better. Let's have a look at it. Right, so what do we have? A petrol fueled company car has CO2 emissions of 202 grams per kilometer, right? The appropriate percentage is going to be what? Now remember, you're always going to round it off to lowest 5 grams. So you always round it off these figures to the lowest 5 grams, which basically means 202 grams basically gets rounded off to be 200 grams. So basically, how do you start off with? To begin with, what is your 95 gram limit? Your 95 gram limit is 14%. Now, what do you do as an additional charge? You basically start 200 grams is the limit, right? How many 5 grams is it more than 95 grams? So, 200 minus 95 divided by 5 is the number of grams. It is more than 95 grams, which basically comes out to be how much? 21. So what do you do basically to it? 21 is what gets divided by, every 1% gets multiplied by 1%. So basically what you do, it gets multiplied by 121 is added to 14, resulting into a total of 35 grams. Now this limit, how does it change if this car was a diesel car instead? First, you do what? You add a supplementary 3% to it, which becomes 38. However, the maximum it can go is 37. Thus, the amount of percentage that you're going to use is 37% if this car was a diesel car instead. So, very simply, what you've done, remember the rules. The rules would not be told to you in the supplementary sheet, but the chart would definitely be given to you. So, you first begin with rounding off the amount of CO2 emissions of the car. You round it off to the nearest lowest 5%. 202 grams become 200 grams. Now what you have to do, the rules say that you need to add 1%. Let me quickly state the rule for you. Add 1% for each additional 5 grams over 95 until the maximum of 37% is reached. So what do you do in this question? 200 grams, how are you going to use? 200 minus 95 is what is told. Divide by 5. So 200 minus 95 divide by 5. You add 1% to it. So multiply by 1%, comes out to be 21% is what you need to add to the base level of 14%, resulting into a value of 35%. If this car was a diesel car instead, what gets added first? A supplementary 3% gets added. So 35 becomes 38. However, the maximum it can go up to is 37% is the maximum it can go up for any type of car, be it petrol or be it diesel car. So very simply, know the rules, be sure how you need to calculate the amount of CO2 emissions of the car. Based upon the CO2 emissions, you calculate the percentage of the vehicle and fuel for private purpose. So basically, what are you doing? Let's get back to the rules. Let me quickly repeat it again. What happens basically, right? So it's company cars, car benefit is going to be determined based upon CO2 emissions of the car, of the manufacturer's list price, the CO2 emissions of the car. The chart is given in the rates and allowances sheet. Depending upon petrol car or diesel car, you need to calculate the percentage. You always round it off to the lower percentage, 5%, right? What next? Basically, what is the manufacturer's list price? Then manufacturer's list price. First, you take the original. What do you take? You start with the original manufacturer's list price. On that original list price, you add cost of the optional extras, which basically means if it is 100 pounds or more each fitted after delivery, if any capital contribution has been made by the employee, definitely that gets reduced because the list price is going to get reduced by it. How much? The capital contributions by employee towards purchase, list price reduced by the lower of the contribution or to a maximum of 5,000 pounds is what the employee can purchase in the car benefit that the employer is providing. What happens when the annual contributions by employee, excluding the specific payment for car insurance, reduces the taxable value basically? Why? Because that is what is the annual contribution by the employee. What do? You take separate calculations for CO2 emissions and manufacturer's list price for each car that has been provided to you. You need to make separate calculations for for every car that has been provided. So what do? You basically start off with the manufacturer's list price. How? You start off with the original manufacturer's list price. On that, you add the cost of the optional extras. If it is 100 pounds or more, gets added to the cost of the manufacturer's list price itself. If they are fitted after the delivery, remember, the rule says that if they are fitted after the delivery, 100 pounds for every extra gets added to the manufacturer's list price of the car itself. What happens in case the employee has contributed something towards the capital of the car? You're going to reduce this total benefit by either the maximum of the lower of the two, which is either going to be the contribution or maximum can be 5,000 pounds. So supposingly the employee has contributed 7,000 pounds towards the car. However, the maximum we can reduce the benefit is by 5,000 pounds. So definitely not a good option for the employee to contribute anything more than 5,000 pounds towards the car, which basically means there's a limit up to which you can take a car as a company car, right? So now let's have a look at how basically this gets calculated. The cash equivalent of this benefit is equals to what? It is the statutory base value of, there is a statutory base value which is the right beginning level of 22,100. This you need to do what? You need to multiply it with the CO2 emissions for the related car. You're going to look at the chart for it and multiply this with the CO2 emissions of the car. Let's better understand this with the help of an example, because when we practically actually do these questions, that is when it actually clicks you that which figure is being used from where. So let's have a look at the benefit of company car. What is the car and fuel benefit that we can take for a company cars? Joan was employed as the sales manager of Wilt from 1st of January 2016. The company offered her a company car, to a maximum list price of 15,000. So the maximum list price to which Joan is eligible to take a company car is 15,000 pounds. But she chose a car with a list price of 21,000 pounds and personally contributed the additional amount of how much? 6,000 pounds. She personally contributed towards the car. 500 pounds of optional extras were fitted after delivery. So what do? For every 100 pounds, you add an additional benefit of the extras that have been included, more than 100 pounds. So this 500 pounds would get added to the manufacturer's list price itself. Why? Because it has been fitted after delivery. The CO2 emissions were 165 grams per kilometer. The company paid for all the running expenses, including the petrol. So let's have a look at what we are going to do in terms of car benefit and in terms of fuel benefit. Let's do the workings first, right? Let's begin with calculating the benefit. First, we begin with calculating the CO2 emissions of the car. So the working one is going to be CO2 emissions of the car, which is equals to what? Which is equals to, we've been told that up to 95 grams, how much do we add? It is always 14, which gets increased by, for every 5 pounds, for every 5 grams more than the threshold level, what gets added? An additional 1% gets added. This is how much? This is equals to, addition is going to be how much? 165 minus 95 divided by 5 is the amount of that it is exceeds by. You multiply this by 1%. You need to multiply this by 1%, resulting into a total of, this is 14, this is again 14. So gets added as how much? Gets added 14 plus 14 equals to 28 is the amount of CO2 emissions of the car. The maximum is 37 here, so it's okay. We're going to take 28 as the CO2 levels of the car. Now what else? We need to do another working. Let's do another working, working 2, which we are going to calculate the manufacturer's list price, which is equals to how much? How much is given to us? The list price of the chosen car is how much? It is going to be list price of chosen car is £21,000 gets reduced by employee, the lower of the two, less lower of what? Either the contribution, which is £6,000, or the maximum can be £5,000. So definitely gets reduced by the lower of the two, which is £5,000. So which comes out to be how much? Equals to £21,000 minus £5,000, £16,000. What do you do, X? You also need to add the cost of extras fitted after delivery, which is given to us in the question as £500 is your manufacturer's list price, now equals to 16,000 plus 500. 16,500 is your list price. Now can we start with the question? Let's now calculate the benefits, the assessable value, which is going to be there under income, under employment income. We are going to first include what the first benefit is of the car benefit. The car benefit is equals to what? It is equals to your CO2 emissions, CO2 multiply by the manufacturer's list price. Now, when was this benefit taken? It was taken in January. So basically the benefit was enjoyed for January, February, March in the current taxes. So definitely you're only going to be assessed upon these 3 months of benefit that you have enjoyed. So what do you do? Basically CO2 emissions I've calculated to be 28%. 28% of manufacturer's list price, which I've calculated to be 16,500. So this is my car benefit, which is equals to 28% multiply by 16500 multiply by how many months it has been used? 3 divided by 12. The value of the benefit comes out to be 1155 in terms of the benefit of the car that we have enjoyed. Now, apart from this, there is also another benefit which the question clearly says the company paid for all the running expenses including petrol. So let's find out the fuel benefit. The fuel benefit definitely becomes what? The fuel benefit. You're going to include what? It is going to be 22,100, which basically is your statutory limit which has been given. The statutory limit 22,100. Multiply this by the CO2 emission level, which is 28%. Multiply this further by the number of months the benefit was actually enjoyed. So 3 divided by 12. Now let's find out the value of this benefit equals to statutory limit 22,100 multiply by 28% multiply by the number of months the benefit has been enjoyed. 1547 becomes the value of the fuel benefit which has been enjoyed by June. So thus what this is what becomes the income, which is going to be taxable, which is equals to how much? The value of the car benefit plus the value of the fuel benefit. Now remember, in the question you will be given a whole lot comprehensive question with all these benefits coming together: living accommodation, job related living accommodation, fuel, car benefit, everything is going to be there. So make sure that you do not get confused. Take each working separately, make separate workings for each of these benefits, calculate the assessable amount and just keep adding it on to your total employment income, the amount of assessable amount. Each of these workings are going to be marked separately. So please make sure that your workings are neat, they are legible. The examiner is able to know that yes, you do know the rules of it. So that's it. Now let's move on to the another benefit, which is now instead of say the car, if what happens if the employer gives you a company van to use. Let's get back to the rules. What happens if the employer is giving a van instead? If the private use is insignificant, definitely you're going to be exempt for this insignificant use of the company van. However, if the private use is significant, you definitely to pay certain amount of tax on it, which is what? If the significant private use is there, that is going to get taxed at the threshold level of 3150 pounds. Now remember, your CO2 levels are insignificant here. Why? Because it's not a car, it's a company van in this scenario. What about fuel? For fuel, again, there is a fixed limit, which is 594 pounds per year is what you have to pay tax upon. So if there's a company van given to you in the question and the private use is insignificant, then that is what you need to tax it straight. First for usage, 3150, and for fuel 594 per year is what gets added as your assessable amount on the company van which has been provided to you. Now let's move forward and have a look at another benefit which the employer can provide to you as an employee. The benefit being in the form of loan. So let's have a look at benefit of loans and the loan interest benefits. So very clearly, apparently, we need to find out what is going to be the value of the benefit that we are enjoying in terms of loan or the loan interest that we are enjoying. What happens if the loan is written off? Loan to employee or his relative basically has been provided and has now been written off. Definitely it gets what? It gets taxable only if the repayment is waived off, which basically means you're giving away a loan and the repayment is not required. So basically it's a salary that you're giving to your employee in the form of a loan. So definitely it becomes taxable only if the repayment has been waived off. If apart from that there is a loan given to the employee or to any of his relatives at a reasonable amount, basically this is basically becomes an exempt benefit that you can enjoy as an employee. But however, if the loan, you need not pay back the loan, so then definitely it's not a loan anymore. It is a salary given to you in the form of a loan. So you definitely need to pay tax upon it. So what happens? It gets taxable only if the loan is written off or the repayment has been waived off completely. What happens when the loan interest benefit? It basically arises if the loan is given at less than the official rate of interest. Now what happens? Supposedly the official rate of interest is say 10%. However, to your employee you've given a loan at a less than rate or less than the official rate, which is 7%. Definitely it is a benefit which you are enjoying as a employee. So definitely you need to pay certain amount of it would become taxable. Taxable as in what? You're going to calculate at one of the two alternative methods, the normal method or the strict method. So whatever becomes less costly to you as an employee, you're going to follow it in order to that amount is going to get taxed upon at either of these two methods, normal method or the strict method. So we are going to find out what these two methods are. The normal interest method definitely is what that you're taking a average of the loan. So you begin with L1, which is basically the amount outstanding at the beginning of the year. Add to it L2, which is amount outstanding at the end of the year. Divide that by 2 to calculate the average loan. Multiply the average loan with the average official rate of interest. So definitely this is the normal method. Average amount of loan gets multiplied with the average rate of interest in order to find out the normal method interest benefit. What is the strict method? Strict method will be levied in case there is a repayment made during the year or a top-up of the loan has been availed during the year. Now the strict method basically applies only if repayment or addition to loan is made during the year, which basically means that you're following a very, very strict method wherein what you're doing, you're calculating the amount of interest on a day-to-day level. So a day-to-day method is being applied. You apply this if the taxpayer elects to or the HMRC actually requires you to follow these strict methods. The HMRC is going to require you when you're actually trying to outsmart the HMRC by following the normal method in a situation where a repayment or an additional top-up has been made. So definitely you can either elect, or the HMRC is going to ask you to follow the strict method. It is entirely the discretion of the taxpayer till then. So let's have a look at an example and find out how we basically calculate this benefit of loan interest. Now, loan has been given to you. Let me just make the notes for you quickly here. So loan on normal terms, which basically means official rate of interest. You obviously have to repay it as well. So it's okay, it's not a benefit. Right? However, if the loan is there and repayment has been waived off, definitely it becomes taxable. Why? Because it is actually a benefit that has been given to you. However, what happens when the loan is now given at less than official rate of interest? Again, it becomes what? It becomes a benefit. So some amount of it you will have to pay tax upon. You can calculate this rate at loan at less than official rate of interest. Like I said, it becomes taxable. You can calculate either under a normal method, or you can calculate under a strict method, which is definitely what? This is average method. This is day-to-day method. This becomes applicable when either a repayment has been made or an additional top-up has been taken. So this is when you need to calculate your loan interest at the less than official rate of interest under the strict method. Let's do a quick question so that we practically understand what is the benefit and how we are going to calculate this benefit. Tate, an employee earning £30,000 a year, borrowed £26,000 from his employers in January 2015 in order to buy a yacht. So in January 2015, which basically means 3 months out of the 12 months, the benefit has been enjoyed, wherein you have basically taken a loan for £26,000. The full amount of the loan, which carried rate of interest at 2% a year, was outstanding on 6th of April. Let me just go what it says. 6th of April 2015. Let me just squeeze it here. Let me just make it more clear to you. Yacht. Right, so what happens up next? Let me just bring it down to the next sheet. Oh dear, okay, let me just wrap text here and bring it, make it broad enough. Oops, what have I done? Lost the question itself, right? Let me just squeeze it. Yes, finally, right. So Tate, an employee earning £30,000 a year, borrowed £26,000 from his employers in January 2015 in order to buy a yacht. The full amount of the loan, which carried interest at a rate of 2% a year, was outstanding on the 6th of April 2015. Tate repaid £8,000 of the loan on 1st of July 2015 and paid interest to his employers of £250 for 15-16. You need to now calculate Tate's assessable benefit for 15-16 on the beneficial loan. The official rate of interest was 3% throughout 15-16. So very simply what we have to do, we need to calculate under both the methods, the normal as well as the strict method. Whatever is more beneficial to us is what we are going to use. So let's find out. Right. under the normal method first. Under the normal method, what am I going to take? I am going to take the value of the average loan, which is equals to how much? Average loan is equals to L1 plus L2 divide by 2, multiply this by the official rate of interest. Multiply this by the official rate of interest. Let's first find out the amount of value first. Average loan is equals to L1. How much is L1? L1 is equals to the amount of loan outstanding at the beginning of the year, which is how much? 26,000 pounds. Amount of loan outstanding at the end of the year after having repaid. L2, how much was paid? 8,000 was paid. So definitely 26,000 pounds minus 8,000 still remains unpaid, which is 18,000 pounds. Can I calculate the average loan? Average loan is equals to 26,000 pounds plus divide by 2. 22,000 pounds is the loan which the benefit has been availed of. So now what do you take? You take interest, you multiply this average loan at the official rate of interest, which is basically how much? At 3%. So how much you should have paid? Average loan multiply by average rate of interest, which is equals to 22,000 pounds multiply by 3% is your official rate of interest. 660 pounds you should have paid. However, how much did you actually pay? You actually paid interest. You paid 250 pounds. So the benefit that you actually enjoyed, the assessable benefit that you actually enjoyed is how much? Assessable benefit which you've actually enjoyed is equals to the total value of the benefit 660 pounds minus how much you've actually repaid 250. The benefit that you've enjoyed is equals to 410 pounds. Now that we calculated this under the normal method, let's calculate the same under the strict method as well. Under the strict method, what happens? We are actually calculating it on a day-to-day basis. So let's calculate strict method. How many months did you actually enjoy the benefit for? For the opening interest, which opening amount, which was 26,000 pounds, which basically means from the 6th of April up till 1st of July 2015, which means 3 months you've enjoyed the benefit for 26,000 pounds, multiply by 3 by 12, multiply by the benefit official rate of interest is 3%, which is comes out to be 195 pounds of benefit you've enjoyed. From 2nd of July up till when? Up till the 5th of April 2016, which basically means for the next 9 months you've actually enjoyed a loan of 18,000 pounds. Multiply by 3%, multiply by 9 by 12, multiply by the official rate of interest, which is 3%, which comes out to be how much? 405 pounds. So total benefit that you've enjoyed is how much? 195 plus 405. 600 pounds is the benefit that you've enjoyed, out of which you've actually paid a due interest of 250 pounds. So let's reduce less interest paid, which is equals to 250 pounds is what you have actually paid. So the benefit that you've enjoyed is basically of 350 pounds. Now, what do you think as an employee, which method would you want to take? Definitely you want to pay less amount of tax, right? So definitely out of 400 and, let me grab my pen, Out of an assessable benefit for £410 or £350, this is the lower assessable benefit. So I would rather choose the strict method and pay interest on pay tax on the lower assessable benefit of £350 instead of going all the way to basically more than £410, which is what gets calculated under the normal method. Now let's get back to the rules. Right. So where were we? Right. So what basically happens, loan interest benefit is when you enjoy a loan at less than the official rate of interest. So you need to pay tax on the benefit enjoyed, right? So but if there is a benefit, definitely you need to pay tax upon it. Under the two methods, normal or the strict, whichever is more beneficial, you can choose, unless this HMRC specifically asks you to choose the other method. Now what happens, there's also another rule to it, which basically states that no taxable benefit if the outstanding loan is less than £10,000, which includes the sum of all the total outstanding loans. So if an employee enjoys a beneficial rate of interest at a loan outstanding of total £10,000, fair enough, let it be, it's a small amount, let the employee enjoy, let's not tax him on the benefit that he is availing. So up to £10,000 the benefit, if you're availing of a lower beneficial rate of interest, it's okay. However, if more than £10,000 including all the outstanding loans, then definitely this benefit becomes assessable. Let's quickly understand this with the help of an illustration. Right. So Rupert had 2 interest-free loans from his employer because it's interest-free. So definitely what it is a benefit from his employer. The average outstanding amounts of each loans for 15-16 were loan 1 £6,000, loan 2 £8,000. Now let's have a look at, as Robert, I can say my loan is less than £10,000, less than £10,000. So it should be exempt. The benefit should be exempt, right? However, what happens here, because what I have to say, the rule states that you're going to look at summation of all the outstanding loans, which equals to £14,000, which is greater than £10,000. Definitely what happens, this is going to be a benefit which is going to be taxable. So basically both the loans are going to get taxed at the applicable rate of interest, which is 3%. So 6,000 at 3% and 8,000 at 3% is what you need to pay tax at. So definitely the benefit is okay up till £10,000 becomes exempt if total loan outstanding is less than £10,000. So you have to look at total loan outstanding. You have to summate, you have to calculate, you have to accumulate all the loans outstanding. Only then this limit of £10,000 is what you can look at. Right? So nice and easy. Make sure that you know these simple rules. The examiner can trick you by giving you these questions as a tricky one marker, as MCQ itself. So know the rules, that where basically how the rules changes depending upon the applicable limit to it. Now let's move forward. Let's have a look at other benefit, which is basically the use of assets other than vehicle, fuel, accommodation, loans, any other benefit that there is in terms of use of the assets apart from what we have already done. Again, what do you use? You definitely need to calculate the annual use benefit, that is the annual use of the benefit that you have availed. What is the total benefit that you are enjoying is what you need to pay tax upon. So the annual use benefit is going to be equals to 20% of the market value of the asset when first made available. From that you can reduce any of the employee's contribution towards its use. No benefit arises for occasional use. So if it's a continuous use, only then it becomes taxable. If it's an occasional use, there and then you've used some of the assets of the employer, okay, fair enough, exempt benefit. If on a continuous basis you are using the assets of the employer, you need to calculate what? You need to calculate the annual use benefit. Supposingly you've used the laptop of the employer all year long, definitely you need to pay the annual use benefit. You're going to pay tax upon it, which is equals to how much? Which is equals to 20% of the market value of the asset when first made available. You can obviously reduce to this value any contributions that you have made as an employee, right? So now let's have a look at these rules. What is the type of asset value that there can be, and what is the cash equivalent if, apart from usage in the normal life, what is happening that there is a transfer benefit which is also going to arise, that arises when the actual used asset gets transferred to the employee itself at the end of an X number of years, which is usually like the end of the useful life of the asset. So apart from annual use benefit, there is another benefit that arises which is known as the, let me grab my pen, which is known as the transfer benefit. So apart from annual use, if the asset gets transferred to the employee at the end of the useful life, apart from annual use, the employee is also going to be assessed upon the transfer benefit of the asset. Let's have a look at the various types of assets and what is going to be the cash equivalent of the transferred value. So all assets except for motor vehicles and computer equipments are going to be, cash equivalent is going to be higher of the original cost to the employer less any annual use benefit to date or the current market value. So higher of these two is what gets taxed as a cash equivalent in case the asset gets transferred to the employee at the end of the useful life of the asset. So supposingly, like an example, you've basically used a laptop of the employer throughout the useful life of the laptop. So you will be charged an annual use benefit. Apart from that, at the end of the life, say 8 years, this laptop actually gets transferred to the employee. Only it becomes the asset, it becomes the property of the employee now. So definitely you will have to pay tax on the known as the transfer charge as well, which is basically you need to calculate the cash equivalent of the benefit that has come to you, which is going to be higher of what? Higher of the original cost to the employer less whatever annual use benefits you've availed from during the life of the asset or the current market value. Whatever is the higher of the two is what you're going to take charge as an cash equivalent of the transfer benefit on the asset itself. What about motor vehicles and computer equipments? Definitely you use their current market value itself. So any other asset apart from motor vehicles and computer equipments gets charged at the higher of the two. For these two, you just use the current market value as it is. Let's quickly understand this with the help of an example. Example number 10. Right. So what is happening here? Rodney, who has a salary of £40,000 a year, was provided with a new camera by his employer on the 6th of October 2013, costing £2,000. So basically what is happening? The employer is giving, it is owned by the employer and used by the employer. Basically, when they costed it £2,000, the employer purchased the asset and gave it to Rodney to use the employee. So basically, you're going to be charged what? You're definitely going to be charged an annual use benefit. What happens up next? Required show the benefit accessible on Rodney if his employer immediately transferred ownership to Rodney on the 6th of October 2013 itself. So as soon as it is transferred, there is going to be also what? There is going to be a transfer benefit. Right? What happens in part B? Show the benefits arising on Rodney if he used the camera until the 5th of January 2016 when ownership was transferred to him for a payment of £100 when the market value of the camera was £500. So this basically is after annual use, every year, and eventual transfer. So let's have a look at both these situations and find out the assessable value of the benefit of the use of camera and along with transfer of the camera. So let's find out under both these situations what is going to be the assessable value of this benefit. Right. So let's have a look at this. Let's have a look at transfer when it is new itself. So transfer when new only. If the asset has been transferred when it is actually new only, so basically what gets transferred? You're definitely going to charge what? The cost to the employer himself, because that is what it has costed the employer, because he's purchased it from the market for £2,000, purchased it and given it, transferred the asset to employee. So definitely this is the value of the benefit that you've got. So the entire £2,000 is what you're going to pay tax upon. This is what the value of the assessable benefit comes out to be. However, what happens in part B? You first using it for its useful life, so you're liable to pay the annual use benefit. Thereafter, after the end of the useful life, this asset now gets transferred to you at when the market value of this asset is £500. So let's have a look at what happens when you're actually using it. Use of asset and subsequent transfer. Right? So first, when you are using the asset, definitely you have to pay the annual use benefit. This annual use benefit you're going to pay every year for year of usage. You begin with 13. 14 is when you begin with what is going to be the annual use benefit. The asset cost is £2,000. It is going to be what? 20% of the market value. So 20% of market value, which is £2,000. Multiply, obviously you need to time apportion it in 12, 13, 14. You only used it for 6 months. So 6 divided by 12 is the annual benefit that you've actually, annual use benefit that you've actually occupied for in 13, 14. Similarly, what happens in 14, 15? Again, you've used this asset. Again, how much it is going to be? You're going to charge 20% of the market value, which is £2,000. You've used the asset for the entire 12 months. So 12 divided by 12 comes out to be £400 as the annual use benefit that you have to pay. What about 2015-16? What is the annual use benefit that you have to pay on it? Basically, again, the same £2,000 market value. 20% of market value, you've used it for the entire, you've used it for 9 months. It is in December, in 5th of January when the actual camera is transferred to you. So up till December, you've used the asset for 9 months out of the 12 months. You're going to pay an annual use benefit of £300. What is the total annual use benefit? Till date, total annual use benefit till date of subsequent transfer comes out to be equals to how much? 200 plus 400 plus 300, £900 of annual use benefit is what you have actually used the benefit of the asset. Now what happens in January? This asset gets subsequently transferred to you as well. So definitely there's going to be what? There is going to be a transfer benefit that you need to pay tax upon. Now what is this transfer benefit? It is basically you're going to use the higher of the two figures. What is the higher of? What does the rule say? Let's quickly get back to the rules. Higher of the original cost to the employer in this case was how much? Let me grab my pen. In this case, this was, let me just erase it. Right. So hire of the original cost to the employer is £2,000. Less annual use benefit to date is how much? 900, which you've just calculated. 1100 or current market value is how much? Is £500 given to us. Higher of the two you're going to use, which is £1,100. So let me quickly make it here as well. Higher of what? Higher of the market value at date of transfer, which is equals to how much? Which is equals to £500, or cost less annual use till date, which comes out to be how much? Total cost was £2,000. Total annual use we've just calculated to be here. Let me quickly grab my pen and show it to you again. I'm in the middle of a formula, so that is why it's not letting me pick up my pen. So pen, right, so £2,000 minus the total benefit that we've used is £900. So let me grab my, let's get back to the question. So it comes out to be £2,000 less £900, which you've used. Higher of the two definitely comes out to be how much? Higher of the two is £1,100. So you're going to use this as the transfer benefit. Let me grab my sheet again. Right, so transfer benefit is equals to how much? Transfer benefit is equals to £1,100 here. So anything else? So total comes out to be how much? 900 annual use, 1100 is the transfer benefit, out of which definitely you need to reduce what? £100 have been contributed. So can you reduce employees' contribution? Yes, you can reduce employees' contribution, which is £100. So total benefit taxable comes out to be 1000 of the transfer and annual use is 900. So totaling to a total benefit of 900 plus 1000. 1900 is the total benefit that it comes out to be, which is going to be the assessable amount of the two. So again, let me quickly go through the workings with you. What is the total cost of the asset when it is transferred, when it is new itself? Definitely you're going to take the cost to the employer himself, as good as just being purchased from the market itself, right? What happens when the asset is used? Sorry, let me grab my pen again. When the asset is used and then subsequently transferred, we're going to get two taxable amounts. First being the annual use, and there is going to be a transfer benefit. So two types of benefits that arise. Annual use, definitely for the number of years you've used it, for the amount of time you've used it, right? So for every year you calculate the annual use benefit, which is equals to 20% of market value. Obviously you need to time a portion for the number of months you've used it during the year. What happens when the asset gets transferred subsequently? You're going to charge at a higher of, so you've got two values to look at: market value at the date of transfer, or you're going to use what? Cost minus, you're going to look at the cost minus the annual use till date. Whatever is higher is what you're going to use as your transfer benefit. Obviously gets reduced by the amount of employees' contribution. Obviously that reduces the amount of transfer benefit. Why? Because the employee has actually contributed something towards its amount, right? So that's it then. Nice and easy. We've done actually all of the important questions that there can be. All of the concepts have been explained to you with good examples. So please make sure that you're doing enough question practice at home, so that you are basically dealing with all these various types of taxable amounts, taxable benefits that there can be, and how the total employment income gets calculated. So make sure that you're doing lots and lots of question practice. Look into your PNR kits, do past papers, do the examples that we've done in the class again so that the concept remains clear. Rules need to be learnt so that you're able to apply these rules. Any limits, any figures definitely needs to be learnt by you. That's it then. That brings us to an end of today's session itself. As usual, absolutely any query you have regarding today's session, we've covered the entire employment income topic in 2 sessions. So please make sure that if any queries you have, you can always email it to me at Shilpi acca@gmail.com. That's it then. Thank you very much for today's class. Thank you.